Hello to all my dear students. How are you all? Are you ready to start the session for your accounting depreciation? Come on. Audio, video, screen, all visible to you. Okay. Without wasting any time, let us start with the topic which we were discussing in the last class. This is a very interesting topic. Now, what I am going to do, I am going to get deeper into the topic and I'm going to develop some of your concepts on this topic. So just be with me with your full attention, full concentration, and no disturbance. Because if you understood these topics, then you are going to understand all the accounting very easily. That would be a piece of cake for you. But if you do not understand these concepts, then you need to learn the accounting, although you can do it correctly then also. But if your concepts are developed, it would be much and much better. Okay, now whatever we have learned is learned. We will do some questions on that also, but right now I'm going to tell you some secret things which are important for the depreciation. Can we do that? Are you ready, guys? Are you ready for some conceptual knowledge of depreciation? Okay, so for example, I have a machine. This machine is used in my factory. I insert the raw materials. This machine processes the goods and it gives me, as a result, finished goods. Okay, this is my core business activity which I am doing. For example, you can assume as a raw material, I use sugarcane. This machine processes it and makes out sugar from the sugarcane that we sell in the market. So that is our business. Now, when I purchased this machinery, when I purchased this machine was costing rupees 1 lakh. This machine was costing rupees 1 lakh. Now, what is happening? 1 lakh will go out of from my pocket. Okay, it will go out from bank account. Yes or no? This will go out for bank account. Yes or no? Everyone, are you with me till now? So if I purchase this machinery today, we are at year zero. I am at year zero. अजीब सा zero था. Okay, we are at year zero and the machine was costing rupees 1 lakh to me. So 1 lakh has been gone out from my bank account today. Now, when I asked the seller of the machine that what is the life of this machine, how many years I can use this machine, so he said the life is 2 years. The life of the machine is what? 2 years. Life of the machine is 2 years. Now what will happen? As per my accounting, which we have learned till now, so this cost needs to be transferred to the P&L account in the form of depreciation. And if I use the formula, that is cost of the machine minus residual value, that is 0 rupees, for assuming that nothing I will get when this machine is scrapped. and divided by the useful life, which is 2 years. So per annum, I have to charge 50,000 rupees as depreciation. Per annum, I have to charge rupees 50,000 as a depreciation. So are you able to understand this concept? Come on, everyone. This we have already discussed. Depreciation will be charged in year one and year two also. Same 50,000 rupees per annum, by which my whole machinery will be written off. It will be out from my books of accounts. Now, what will happen? Let us prepare the profit and loss account of year one and profit and loss account of year two. Let's say in both the years, I have a gross profit of 1,20,000. I have a gross profit of 1,20,000. Okay. Sir, I asked about who is and how a life of asset and scrap value. What are you saying, dear? I'm not able to understand your query. If you are asking that how we have determined the scrap value, so that is given in the question, life is given in the question, the cost is given in the question. So I have calculated the depreciation per annum as per straight line method, SLM method. Okay. Now try to understand what my PNL will do. In my PNL, I will charge the depreciation of the machine as 50,000. And here also I will charge the depreciation of the machine as 50,000. Now, what is the profit I am getting after charging the depreciation? So earlier I had a gross profit of 1,20,000. I will charge the depreciation of 50,000. So what is the net profit which I am remaining with? So the net profit would be rupees 70,000, which will be transferred to my capital account. And here also to net profit 70,000, which is transferred to my capital account. Now, just think that this 1,20,000, this profit I received in cash. Because, for example, I purchased the goods of, I purchased the goods of 1 lakh and I made a sale of 2,20,000. So the gross profit was 1,20,000. It was my gross profit. So let's assume whatever purchases I have made in cash. So 1 lakh has gone out, but I have received 2,20,000. So net 1 lakh has gone out, 2,20,000 has come in. So the gross profit, the cash which has come in is rupees 1,20,000. So this 1,20,000, I have it in cash. But do you think for depreciation, whether I need to pay any cash? Answer is no. I'm not paying any cash, but I'm charging it to my profit and loss account. Now everybody see it very carefully. What is going to happen? So in your screen, if you see in your year number one, okay, in your year number one, you have got a cash of 1,20,000, and I am showing my net profit as 70,000. I am showing my net profit as 70,000. Now what will happen? extra cash. $50,000 is being saved. Extra cash, it is saved. Why it is saved? Because it is saved in the name of depreciation. And how it is saved in the name of depreciation? Because it is a non-cash transaction. It is what? It is a non-cash transaction. So in the first year, if 50,000 is saved, in the same way, in second year also, I will have rupees 50,000 in name of depreciation being the non-cash transaction. So when my both the years will lapse, when my both the years will lapse, so now what will happen? After year 1 and 2, the owner will have extra cash of rupees 1 lakh. Rupees 1 lakh. And now what he's going to do with 1 lakh? Obviously, sir, he was doing the business of sugarcane. Now, if this machine is going to be dead by 2 years, that means its useful life is only 2 years. Okay, its useful life is only 2 years. So now I have to buy new machinery. I have to buy new machinery. So for buying that new machinery in my books of accounts in the name of depreciation, I have collected a sum of rupees 1 lakh. So that is the conceptual knowledge behind the depreciation. It is a non-cash transaction. Every year I am charging it to P&L. That means some cash I am taking out from my profit and loss account, taking out from my profits in the name of depreciation, and I am keeping it as reserve for buying the new machinery when the existing machinery is not in use or its useful life is over. That is the concept, real concept of depreciation. Okay. So now after 2 years, I will buy a new machinery and I have the funds also to buy the new machinery. That was the concept I was trying to tell you. Now, sir, why we are making a provision for buying the new machinery? Because we say that our business is a going concern. It is a going concern. That means that means it will run for infinite years. So I will not close down my business in just 2 years because my machine is dead, but I will buy a new machinery and start my business all over again. Okay, not all over again, I will start, but I will continue my business as it was running. Okay, so that is the concept. We are taking out the funds from the regular business profits for the buying of new machinery. Now, anybody of you can say that, sir, mm, earlier the machine was of 1 lakh rupees. Now the price may go up, let's say 1,20,000, or it may go down as 70,000. So obviously, some extra contingency you can take, but more or less, major part of your cost is covered by this depreciation. Major part of the cost is being covered by this depreciation. Okay, so in accounts we can take provision of only those costs. There is one more method by we can take the provision of more cost also that we are going to discuss later on. But up till now, this is the concept for straight line method. Okay. So now I've received one question that suppose I worked at any place as an accountant. My company purchased a computer, so I asked about this. How is life of computer and its scrap value? That who is going to determine the life of the computer and the scrap value? Obviously, beta, that depends on the experience of the business, that how many years they use the computer. For example, in an IT company, it can be it can be replaced every 3 years because technology gets changes. But in a normal shop, it can be used for 10 years also. So both the cases are possible. That depends on business to business. That depends on business to business. Okay, so you have to ask from the management of that business. They are going to determine that in how much rupees they are going to sell this furniture and after what period of time. So that is the concept which is in the real life. And just as a tip, I want to give you that if you're working as an accountant in any company and the company says, I have no idea what scrap value should be, what is the life of the computer, you can refer the Income Tax Act. So Income Tax Act has suggested depreciation rate on your assets. So you can use that rates as is. Okay. That is the suggested something from Income Tax Act that can be used if no clue is available to the management. Obviously, if you are doing the income tax return, you need to follow the Income Tax Act only. Okay. If you're doing the income tax return, you need to follow the Income Tax Act 100%. But if you're not filing the income tax return, but you're just doing the accounting, then you can do as per the management, and there should be an adjustment entry which can be passed later on for reconciling both the depreciations as per your accounts and as per your income tax. Okay, that is a case of deferred revenue and deferred expenditure. So that's what something not in our course, nothing from our part, just I have given a clue because the doubt was raised. But this was the whole concept which I told you of depreciation. Now today, I am going to tell you one more method of depreciation, which is similar to the process which we have done right now. This is similar to the process which we have done right now. That is called sinking fund method. So what is sinking fund method? Okay, this is a method by which what we can do, we can collect the cash. This is the method by which we can, I would say not collect, but arrange the funds for buying new asset when life of old asset is over. So what we are doing, we are studying a method where we can arrange the funds for buying the new asset when the life of the old asset is over. This is not exactly same to what our depreciation is, but a different way. So what they are saying? They are saying as per the traditional depreciation method, as per the traditional depreciation method, what you were doing, you were finding the cost of the asset. Okay, this will be called as COA. Cost of asset is COA. COA was 1 lakh. useful life was, let's say, 2 years. Useful life was 2 years. Now, if I give you some information, what information I can give you? That there is a fixed deposit available, there is a FD available, or I would say there is a recurring deposit available. What is recurring deposit? That if year one I deposit the X amount, recurring deposit of 2 years. Okay. And in year two, I again deposit that amount. So at the end of year two, I will receive a sum of, let's say, 1 lakh rupees. So obviously I need 1 lakh rupees to, to what? To buy a new machinery. So the bank is saying, do one thing, do one thing. You can book a FD for rupees 47,000 in the first year and again 47,000 in the second year. Not FD, but a RD. It is called a RD, that is recurring deposit. Every RD can be every 1 month, like an EMI. It can be every quarter, every half year, whatever frequency you want, that you can select, or yearly. Okay, any frequency you can select. But let's say we are talking about a yearly frequency of this recurring deposit. So bank is saying deposit 47,000 in the first year and 47,000 in the second year. On the first year, I will give you a interest of, on the first year, I will give you a interest of, let's say, let me calculate. So let's say 3,500 rupees will be given as interest. 3,500 rupees will be given as interest in the first year, and in the second year it would be not 3,500, make it 2,500. Let's make it 2,500. And in the second year interest would be, just a hypothetical example we are taking, in the second year interest would be 3,500. Okay, so now if you calculate all these parameters over here, you can see that 47,000 I have deposited in year one, 47,000 I have deposited in year two. First year interest would be 2,500 and second year interest would be 3,500. So total sum which I am receiving is equivalent to 1 lakh by this investment method. So do you think that business owner will try to adopt, yeah, they will try to take this RD to deposit the money because it is giving some interest also to them, not just the amount invested, but some return on it. Okay, they are giving an interest also to them along with the funds which they have invested, obviously. Yes, so they are getting their desired sum of 1 lakh rupees after the end of year two, and they can buy a new machinery. So what was happening in the earlier case? Here, what is happening in this year? This case. In this case, the funds were idle and kept with company only. Okay, in this case, the funds were idle and kept with company only. in the first case, because there was no fund where they have invested. They have just collected the money from themselves, and after 2 years they have received 1 lakh rupees as a non-cash transaction, and owner will have that extra cash, then they can buy a new machinery. But in the second case of sinking fund method, what they are doing, they are investing that money into a fund. That fund will be called sinking fund. Why it is called sinking fund? Because it has a limited life. It has a limited life. And after that, this fund will sink. Sink means it will be drowned, it will be closed. So for that purposes, it is called sinking fund. So what company is doing? Company is investing that money into a fund, and that fund will give the company the return on the investment. And based on that investment, the company can buy the new machine. Is everyone clear with the concepts which I have told you till now? I'm not telling you any journal entries as of now, but I am telling you the concept. Are you comfortable with that concept? Yes or no? Journal entry is the easy part. Obviously, I know you can do those, but if you understand the concept, then everything becomes a piece of cake, as I said. Just confirm me. Are we okay with these concepts? Okay, great, lovely. Now, everything which we have discussed, now we are going to discuss the journal entry for that. That what will happen in our books of accounts. So in the books of accounts, obviously, you will book your depreciation. How you are booking your depreciation? That is depreciation account debit to your asset account. If it is a machinery, then you can use the machinery account. So that is the simple thing you all, or everybody knows this journal entry, right? But second entry was profit and loss account debited, and the depreciation was transferred to the profit and loss account. The depreciation was charged to the profit and loss account. But now what we are doing, we are creating a sinking fund. So we need to do the journal entries for that fund. Whenever I will make an investment in that fund, I need to record that transaction as an asset and as a liability also, because we are taking out from our business. That funds we are taking out from our business. So in the third case, what will happen? You will debit your profit and loss account. You will debit your profit and loss account, and you will transfer that amount to the sinking fund reserve. You will transfer that amount to your sinking fund reserve account. Okay. How much money you will transfer? So in the first year, you need the investment of 47,000. So let's say 47,000 you have transferred from your P&L. You have taken that money from your profits and you have transferred to a reserve. This reserve is a liability because in future you need to pay out of this reserve. Okay, this is a liability because in future you need to pay out of this reserve for buying a new machinery. Now, fourth, when I will make this investment, so bank will give me an RD certificate, a recurring deposit certificate. That is an asset for me. So that is an investment. So I will debit what comes in sinking fund, investment account debited. sinking fund investment account debited, it will be debited by 47,000. That is the investment which I have made to bank account because that fund will go out from my bank. If I am investing that, so it will go out from my bank. So this is the sinking fund investment account debited with 47,000 and we have transferred it to bank account. Okay, we are just learning what we have discussed before, the concept, but obviously the practical part we are going to do with the questions. So that would make your life a bit easier. But right now, so this is the entry for investment and this will be shown as a asset. This is a asset for you. Okay, because this investment will give you some returns. And if you are getting some returns, that is your income. Okay, from that your investment will increase. So how you are going to increase that investment? So sinking fund investment account debit, in the first year I am getting an interest of 2,500 rupees. Two, interest income, because that is the income which we have received. Income should be credited and your asset will be increased by 2,500. Okay, because that the bank will give me in return. And this invest interest income will be transferred to the PNL that we do normally. Transfer of all entries, that is interest income account debit 2,500 and it will go to my profit and loss account as an income because this is the income. Okay, this is the whole accounting for your sinking fund. This is the whole accounting for your sinking fund. But yes, obviously we are going to do with some examples, with some questions. Let us first take an example and see the journal entries which are given in your book for this. And then we will go back to our traditional thing which we were doing as a depreciation accounting. Okay, so this is the sinking fund method. A sinking fund is a fund created with a specific purpose, which may be to repay a long-term liability, to repay an asset, or to replace an asset or of a depreciable nature, or to renew a lease. Right now, what we are doing, we are understanding the depreciation part of it. We are understanding the depreciation part of it. Obviously, you can uh, create your sinking fund for other purposes also. For example, you need to do some investment or you have taken a loan which you need to pay after a period of time. So for repaying a loan, you can take out some money from your regular profits and invest somewhere. You can invest in some funds which can give you a good returns, or you can replace an asset that is a wasting asset. Okay, so that is the extra part. But how this is being calculated? So at the end of the first year, the simple annual depreciation, what we do, we transfer the P&L to depreciation. That is the annual contribution which we are going to make. So from P&L, I will from P&L, one second. P&L account would be debited to sinking fund account. Now here I will transfer that amount. I will transfer that amount which I am going to invest as an annual contribution to my fund, as an annual contribution to my fund. Okay, because that amount will be invested. For annual depreciation, you will what do? You will do P&L account debit to sinking fund account as a 47,000 rupees. And then when you invest that money actually, so it will be sinking fund investment account debited rupees 40,000 to bank account 47,000. Okay, that is your second entry which you need to consider. At the end of second year, again we will do the same entry, that is P&L account debit to sinking fund account as an annual contribution. And again, if we are investing something, we will get return on it. So when we will get return of it on it in our bank account, so it will be bank account debited to interest income. Okay. In your books, it is given you have received you have received the interest. That is the assumption. And in my explanation, what I have told you here, the interest income here, the interest income was due. It was due. That is, it was accrued, right? Here we have accrued the interest, and here it is actually received. So whenever it is actually received, what we are doing, we are debiting the bank account with the amount which is received and crediting the income account, which is the annual interest. That is the difference, but both the concepts are same. And obviously then you will transfer the interest on income to the sinking fund account, that is the interest transferred. And at last, at last, if you sorry, not at last, but if you have made any further investment in the second year or the subsequent year, so you will debit the sinking fund investment to the bank account. This is same entry as we have done in here on the second part. Okay, sinking fund investment to the bank account. Okay. So when the working life of the asset from first, second, third, same as above, and fourth, not made in the last year, whenever that is life of the asset is over, now that that is the time where we will sell our investment. And whenever we will sell our investment, I will get back the money. That is why bank account will be debited and my asset will be credited, because this asset will be gone and this will be sold in the market and I will get the cash in my bank. Okay. Now, if this investment is sold, I have got the cash. Now what I will do, whatever the balance is remaining in the sinking fund account. For example, I thought, I thought I will receive 1 lakh rupees, but actually I got some bonus and I have received 1 lakh 1,000 rupees. So 1,000 rupees I have received extra. So that profit on sale will be transferred to the sinking fund account. It will be transferred to the sinking fund account. Okay. Then your sinking fund account will be debited. Sinking fund account will be debited because that was the reserve which we were creating, and your asset will be closed. Your asset will be closed. For example, your asset was of 1 lakh. Now every year I have invested some money, 1 lakh. So that 1 lakh will knock off my sinking fund investment and it will knock off my asset. So there is no need to charge the annual depreciation which we were charging every year. Okay, this was the traditional way. This was the traditional way. But now instead of charging the depreciation every year, what I am doing, the equivalent amount I am charging it to the sinking fund reserve account. And when the sinking fund reserve account will be completed, that the life of the asset will be completed. So I will cancel out my asset from the sinking fund with 1 lakh rupees. That is the cost of asset. Okay. And at the end, your sinking fund account will be debited and your sinking fund investment account will be credited if there is loss. For profit, we have done already the entry over here, but if there is a loss, then you can book it like this. Okay. Obviously, if you haven't got anything, now it is the time when we will do one question and we will understand what is the exact procedure we need to follow for this. Okay. So on 1st of July 2016, W Limited purchased a machine worth rupees 1,10,000 and spent rupees 6,000 on its installation. So what is the cost of asset, COA? So cost of asset will be 1,10,000 plus 6,000. So it would be 1,16,000 rupees. It is your COA. Life of the machinery is 4 years. Next, what they have given, at the end of which it is estimated that scrap value will be 16,000. Scrap value is equals to 16,000 rupees. Desiring to replace the machinery on the expiry of its life, company establishes a sinking fund. Company is making a sinking fund. Investment are expected to realize a interest of how much beta? 5% interest. They are expected to realize a interest of 5%. So they have not given the amount of interest, but they have given the rate of interest. So we will calculate that. Okay, what date we have purchased? We have purchased on 1st of July 2016. Cost is given, life is given, scrap value is given. You can calculate the depreciation as per straight line method. Now, after 4 years, on 30th of June 2020, machine was sold off for a scrap value of 18,000. Actually, we thought it will be sold in a for 16,000, but when the year passed, it has actually been sold out for 18,000. Okay, that we can do, consider, we know. And the investment were retained at 5% less than the book value. For example, investment was of 1 lakh. It was kept at 5% less than the book value. That means they are kept at 99,500. It is 5% less than the book value. Okay. On 1st of July 2020, after your useful life is over, a new machine is purchased and it is installed at a cost of 1,25,000. What was the cost earlier? The cost was 1,10,000 plus 6,000, but now the cost is 1,25,000. Oh my God. This is a very good example. Okay. Sinking fund table shows that 0.2320 invested each year will produce rupees 1 at the end of 4 year at 5%. So this is the rate they have given. For example, if you have invested 0.2320 in year 1, in year 2 you have again invested 2320, in year 3 you have again invested 2320, and in year 4 you have again invested 2320. So after 4 years you will get rupees 1. So if you want to calculate the interest, can you calculate it internally? So nothing, it is 0.2320 4 times, it will become 0.928. This is the invested amount. This is the invested amount. And how much would be the interest? If you deduct 0.928 from 1, so 0.072 will be the interest. It will be the interest amount. Okay. So that is the basic information they have given. Obviously, you are not going to ask that much technical, but yeah, you should know the concepts behind all of these. So if I want 1 lakh rupees after the end of 4 years, so what investment I need to make? So annual contribution should be multiplied by 0.2320. So every year, if I will contribute 23,200 for 4 years, so I will get 1 lakh rupees at the end of 4th year. So I will get 1 lakh rupees at the end of 4th year. Okay, so that is the calculation which we have done till now. From where this 1 lakh has came, obviously your cost was 1,10,000, then you have added 6,000 in installation, but you have to reduce the scrap value, that is 16,000. So your net cost is 1 lakh rupees. So that is why we need to arrange 1 lakh rupees. We need to arrange 1 lakh rupees so that whenever After 4 years, this asset will be sold as a scrap. I will get 16,000 from the scrap, and I need to arrange 1 lakh. So I will get again 1 lakh 16,000 back. But actually we have received 18,000. So that is a different matter. For accounting, we will do the entries. That is a different matter. But we are in the first year. We are in the year first right now. We do not know after 4 years how much it will be sold. Okay. So obviously we will make our assumptions. We can make our estimates, which they are doing. Now what you have to do, you have to show the necessary ledger accounts in the books of W Limited. Now see, everybody see. In the books of W Limited, they have prepared one sinking fund account. Now see how this fund works. So this is the year one end. You have bought the machinery. Now this is the year one end. Every year, how much you have to contribute? 23,200. So what we have done, we have credited the sinking fund account and debited the P&L account. So in my P&L, let's say this is the depreciation which is charged every year. This is the depreciation which is charged every year. 23,200 has been received in the name of depreciation, and we will make a investment. We will make an investment of 23,200 at the end of year, at the end of year one. Is everybody with me and understanding that how we have passed this general entry? We have done the calculation. Now only general entry needs to be passed in both the sinking fund account and the sinking fund investment account. Okay. Now, first year has ended. In the second year, when your year two has started, this balance will be, oh, sorry, this balance has been brought down and, okay, let us read out again. On 1st of July 2016, on 1st of July 2016, we have purchased this machinery, and they have given no information about closing the books of accounts. Okay, so just add one line in your question that the company closes the books of account. Company closes books on 30th June every year. So if the company is closing the books of account on 30th of June, we have purchased on 1st of July 16. So my year will end on 30th of June 2017. So that is the first year end which we have taken. Okay, that is the first year end which we have taken, and by this there is a balance which is brought down of 23,200. This should be the balance carried down. This should be the balance carried down. That there is a misprint, and here it would become the balance brought down 23,200 as it is. Now we will receive interest on this 23,200. So interest would be 1160. The interest would be 1160, and again this year we will make a reserve of 23,200. So what is the balance at the end of year two? Now we are at the end of year two, so the balance carried down here would be 47,560. Now let's see the investment account. Investment account, we first made an investment of 23,200. That would be the balance carried down to the next year. In the next year the balance will be brought down, obviously, but now you will receive the interest. You have received the interest of 1160. Okay, that interest will again be invested in your fund, and along with the interest you will invest your installment, that is 23,200. So now the amount invested would be 24,360. How you have calculated this? Nothing. 23,200 plus the interest amount. So interest amount is 5% of 23,200. That is 1160. 1160. That is 1160. Okay, so the balance carried down is 47,560. Now let's go to the year three. Year three. Last year, the balance carried down was 47,560. It will be brought down to 47,560. The interest would be charged the 5% of how much? 5% of the amount which is being created as a reserve or the amount which is invested. Okay. So what is the amount which is invested? 47,560 multiply by the 5%. So it would be 2378. It would be 2378. And again, you will brought a new investment, sorry, new depreciation which will be charged in this year of 23,200. So the balance at the year end third would be 73,128. And it will be brought down to the next year. Let's see the investment account. In this investment account, in the fourth year, the balance brought down is 47,560. This is the fourth year. The balance brought down is 47,460. Now again, you will invest the interest along with the your installment of 23,200 plus 2378. So the investment amount would be 25578 and the balance carried down would be 73138. This will be again be totaled and we will go to the year 4. This was year 3. Earlier here it was year 3 and now we are on the year 4. 73,138 is the balance brought down. And here also, if you see your sinking fund account, the balance is 73,138. Now again, the same thing will happen. You have to charge the 5% interest on your 73,138. The interest is this much. You will again take out the depreciation from the P&L of 23,200. And now the twist, what is the total which we have? So we have near about 9995, which is equivalent to rupees 1 lakh. So that is the reserve which we need to make right now. Okay, everybody knows we need 1 lakh rupees at the end. So now we have 1 lakh rupees in our fund account. Let's see what our investment look like. So in investment, if I say 73,138 is the balance which is brought down, but now what we are going to do over here, they say the highlighted part in the question. If you see over here, investments were retained at 5% less than the book value. So what was the book value in our books? The book value was 73,138 and they have retained or say they have sold the investment less than the book value of 73,138. So is it possible? Obviously, if you invest in the share market, the price may go down. So if I calculate the 5% of it, it is rupees 3657. And if you reduce this 3657 from 73138, you will get 69481. So if the investment is sold for 69481, the balance was 73,000. We have sold it for 69481. So there is a loss of 3657, which we will need to book. This is a balancing figure. This is a balancing figure as per the question given. Okay. So now my investment account is closed. Let's look at the sinking fund account. Sinking fund account. So in the sinking fund account, we had 73,138, the interest amount of 3657, and the new investment of 23,200 in the form of depreciation. Now, if you see there is a loss of 3657, this will go from your investment account to your reserve account. Okay, this will go from your investment account to the reserve account, and the balancing figure, we will transfer it to the machinery account by 96,338, and this account will be closed at 99995. Now this will be closed. Now I know that there would be several questions in your mind. Sir, they have transferred 96,338 to the machinery account. The machinery had the book value of 1 lakh rupees. Sir, how 1 lakh? We assume that the machine was of 1 lakh 10,000 plus 6,000 as installment. So the machine was of 1 lakh 16,000. So the book value was of 1 lakh 16,000. But what actually we thought? We thought the 16,000 would be the scrap value. So net, I need 1 lakh for the machinery. But what actually happened? This is the background story. They have not prepared the machinery account. If they have prepared, that would be much easier. But in your machinery account, your asset is showing at asset is showing at 1,16,000. Now, in the scrap value, what you have actually received, you have received 18,000 from the scrap value. So if I deduct 1,16,000, 18 minus 18,000. So now the book value of the machine is 98,000. The book value of the machine is 98,000. And how much I have transferred from the sinking fund investment? I have transferred rupees 96,338. So again, in the sale of machinery, there is a loss. There is a loss of 98,000 minus 96,338. That is 1662. There is a loss of rupees 1,662 in selling the machinery. Okay. So this will be booked in your P&L account as a loss and credited to your machinery account. That is how all the interest, your sinking fund, your depreciation, and everything will work. Okay. That was your sinking fund investment. You do not need to learn this in very details, because this is just a little bit of snip which is given in your I would say in your notes. Nothing much questions are expected from this. Major question are expected from the concept which I already asked you. I've done the first part of this illustration number 1, and I asked you to do the 2, 3, and 4. I hope that you have already completed. If you have not completed, let's discuss it. The cost of machinery is 24,000. Expenses incurred is 7,000. So 24 plus 7 would be equivalent to 31,000. Residual value is 1,000. Okay, so it would be 31,000. The cost minus residual value of 1,000 divided by the expected life of 6 years. So annual depreciation would be 5,000 rupees in second case. Sorry. 31,000. They have taken the residual value of 3,100 over here. That is incorrect, beta. They have done a wrong calculation in the books. Correct it as 1,000 and your depreciation would come as 5,000, and 5,000 would be around, let's say, how much percentage? 5,000 divided by 31,000 multiplied by 100. So 5 divided by 31 multiplied by 100. Here the answer would be 16.13% approximately. 16.13%. They have done the wrong calculation. In the third one, 95 plus 15. Okay, this will be 1,10,000. Residual value is 20,000. So it will be deducted from 1,10,000. So net value will be 90,000. 90,000 divided by 3 would be 30,000. So here also they have done it incorrectly. Cost of the machine. See, they have taken the cost itself incorrect. It is 95 plus 15, that is 1,20,000. Here they have written 1,05,000 and 20,000. So just ignore that, but do your calculations yourself. These are incorrect information. Okay, so if I do the third one, so it would be 95 plus 15, 1,20,000, and residual value is 20,000. So 1 lakh I need to divide for how many years? I need to divide it for 3 years. So it would be 33,333.33 rupees of depreciation. And if you divide 33,333 divided by 1,20,000, you will get the percentage, which would be around 27% approx, 28% approx. Okay. Last here, 2,20,000 is the cost of machinery, plus 80,000 would give us 3 lakh rupees. If I deduct 3 lakhs, the residual value we deduct as 50,000, so it will give me 2,50,000. So per annum depreciation would be divided by 5 years, so it would be 50,000 rupees. It would be 50,000 rupees. Just ignore this calculation, these are all incorrect. Okay. Now I have also given you illustration number 2 in your homework. Illustration number 2 was very simple. Machine was purchased for 7 lakh rupees. So this type of questions are more expected from you. This is the less technical part, but yes, most weightage for this part. Okay, so the machine is purchased for 7 lakhs. The expenses incurred is 3 lakhs in installation. So the machine cost of the machine is 10 lakhs. This is the cost of asset. Calculate the amount of depreciation at the rate 20% according to the straight line method after the first year. What is the year end here? Year end is 31st of March. Year end is 31st of March. If the machine is purchased on 1st of April. Okay. So let's go to our notes. If the machinery is purchased on 1st of April, my year end is 31st of March. Full 12 months is there. So what is the depreciation rate? In the question, it is given as 20%. What is the cost of asset? It is 10 lakhs. Therefore, depreciation would be 10 lakhs multiplied by 20%. 20%, that means 20 divided by 100. And multiply by number of months it is used. It is used for 12 months. So it will be 12 divided by 12 because in total also there are 12 months. So what would be the depreciation figure in the first case? It will be 2 lakh rupees. But let's go to the second case. In the second case, if it is purchased on 1st of July, so now if it is purchased for 1st of July, the months here are 9 months. How I calculated 9 months? July, August, September, October, November, December, January, February, March. So total 9 months over there. So if it is used for 9 months, so depreciation will also be charged for 9 months only. So depreciation rate is 20 divided by 100. And how many months it is used? It is used for 9 months. So multiply by 9 and divided by 12. So this calculation will do. That is 1,50,000. That is the case number. Okay. Third case. If it is purchased on 1st of October. So now if we are on 1st of October, we have 6 months left. 6 months. October, November, December, January, February, March. So depreciation will also be calculated for only and only 6 months. 10 lakh cost of asset multiply by the rate of depreciation multiply by 6 months divided by 12. So this will come 1 lakh rupees. So in the first year, you will charge the depreciation of just 1 lakh rupees. Last, if it is purchased on 1st of January 2021, so if it is purchased on 1st of January 2021, so there are 3 months, January, February, and March, for which the asset is used. So in that case, my depreciation would be 10 lakhs multiplied by 20%, multiplied by 3 divided by 12, that will be equal to 50,000. So that would be the depreciation amount for your first year. So the blue one is the case number 1, red one is case number 2, green one is case number 3, and the black one is the case number 4. That was your question number 2, which I have given you in homework. Are you okay with this? Any doubts, beta? Okay, moving on. For third, there is one doubt. So 95,000 plus 15,000, that will give me 1,10,000. 1,10,000 divided minus 20, that is 90,000. 90,000 divided by 3 will be 30,000. Yes. So in the third case, the depreciation was 30,000. That's what I told beta. Okay. Great. Now let us solve illustration number 3. On 1st of January 2000. Okay. This is another method of calculating the depreciation. Let us first understand that. So first method I have explained you, that was straight line method, where you had the formula of cost minus residual value divided by the useful life. Okay. Now I am going to tell you another method of depreciation. This is also a famous one which is used majorly in every industry. That is called reducing balance method. In this method, the depreciation rate is given, and they say the depreciation rate is on the written down value of 20% each year. So if it was a straight line method and you have been given a cost of asset is rupees 1 lakh, life is 5 years. So what you have done as per straight line method, 1 lakh is the cost of asset. You multiply it by the depreciation rate. Depreciation rate we have multiplied. So the depreciation for the first year would be, this is the year number 1. So depreciation for the first year would be 20,000. Okay. So what is the balance of asset left? What is the written down value of asset left? So original amount was 1 lakh, 20,000 is charged as depreciation. So the balance left is 80,000 rupees. What will happen in the next year? In the next year also, the original cost was of 1 lakh rupees. Depreciation rate is 20%. The depreciation will be charged at 20,000. Now the balance was 80,000. So 80,000 minus 20,000 at the end of year 2, my balance left would be 60,000. Third year, again 20,000 will be charged as depreciation. Now my balance left would be 40,000. Fourth year, 20,000, again depreciation. Balance left also 20,000. And last and the fifth year, again depreciation will be charged at 20,000 and my asset will become zero in my straight line method. This was your straight line method. But now what we are doing, now we are learning another method, that is reducing balance method. Okay, this is also called return down value method, WDV method. They say that if the depreciation rate is given, let's say 20%, and cost of asset is given 1 lakh rupees. So every year this 20% will be charged on WDV. It will be charged on WDV. That is the return down value. What is the return down value? It is cost minus depreciation. It is cost minus depreciation. So let us make a table. First table is the year. Second is the opening balance of asset. This is the opening balance of asset. Then the depreciation which needs to be charged and the closing balance of the asset. So I have 4 columns over here. The year, opening balances, depreciation, and the closing balances. So in the first year, the opening balance was 1 lakh rupees. The depreciation will be charged at the rate 20%. So it would be 20,000 and the closing balance would be 80,000. Okay. Now if you see the straight line method, here also the opening balance was of 1 lakh, depreciation was 20,000, the closing balance of 80,000. So it is same. Sir, what is the difference then if it is same? Now the difference will be from year number 2. In year number 2, the opening balance would be 80,000 and depreciation will be charged on the opening balance only. Now the depreciation would be 20% of 80,000, that is 16,000. So now see why it is called reducing balance method, because now the depreciation is reduced. Why it is reduced? Because we are charging the depreciation on the WDV, that is 80,000. So what is the closing balance of asset left? It is 64,000. In our SLM method, the balance was 60,000. But now in return down value, the balance is 64,000. Okay. The balance is how much? 64,000. In the third year again, the closing balance of the previous year will be the opening balance. Again, depreciation will be charged on the opening balance, that is 64,000. So 20% of 64,000 is 12,800. And if I deduct 64,000 minus 12,800, so this would be 51,200. In the fourth year, again 51,200 and 20% of 51,200 is 10,240. Then you will deduct 51,200 minus 10,240. The balance would be 40,960. And this will go on and on and on until the asset is sold. Until the asset is sold or it is discarded. Discarded from use. Okay. This method is logical when you do not know the exact life of the asset. You do not know the life of the asset. But if you know the exact life, SLM is more logical, because after 5 years, the balance is zero. The balance is zero. But here, this will go on and on and on and on and on. This is the return down value method. Now, if you see your question illustration number 3, this is based on your return down value. A machine was purchased for 1,50,000 paid for installation. Assuming the depreciation rate is 10% on reducing balance method, calculate the amount of depreciation up to 31st of December 2020. So we have to calculate it for 2 years. So in 3 years, I would say. So in the first year, 2018, the opening balance is 1 lakh plus 50,000, 1 lakh 50,000. 10% is the rate of depreciation. So 10% of 1 lakh 50,000 is 15,000 rupees. And if I deduct 15,000 from 1 lakh 50,000, so the balance would be 1 lakh 35,000. So last year closing will become opening for the next year 1 lakh 35. Now we will multiply the 10% on 1 lakh 35, not 1 lakh 50. Because if we multiply on 1 lakh 50, then it will be straight line method. Okay. Straight line method, always multiply the depreciation rate on the cost of asset, that is the original cost. This is your straight line method. But reducing balance method charges the depreciation on the WDV. Okay. On WDV, it charges your depreciation. So 1,35,000 was the WDV over here from previous year. 10% depreciation is charged. Then the depreciation amount is 13,500 and the new WDV would be 1,21,500, which will be carried forward to the 2020. That would be the new WDV, and it 10% of the WDV would be 12,150, and finally the closing balance at the year end of 2020 would be 1,09,350. Okay. So this is how the reducing balance method or the WDV method works like. We have a similar type of question in the illustration number 4 that will be given as your homework. Just read it out, the question. Yeah. So what they have given, on 1st of January, machinery was purchased for 80,000. On 1st of July 2019, after approx 1.5 year, additions were made to the amount of 40,000. So that would be capitalized to your machinery. On 31st of March 2020, machines were purchased on 1st of July. So this machine, which was purchased later on, there are two machines which is purchased. First on 1st of January 18 and second machinery is purchased on 1st of July 2019. On 31st of October 2020, the machine which was purchased on 1st of July 2019 costing rupees 12,000 was sold for 11,000. Now again they have done a wrong entry over here. This should be 1st of July 2018, because obviously if you have purchased a machine in July, no, it's fine, it's fine. No, it's fine. It is correct. Sorry. So in 2020, you have sold a machine which was purchased on 2019. It was originally costing 12,000. It was sold for 11,000, and 30th of June 2020, the machinery which was purchased originally on 1st of January, this machine costing 32,000 was sold for 26,700. On 1st of October 2020, additions were made to the amount of 20,000 and depreciation was provided at the rate of 10% on the diminishing balance. So diminishing balance is the reducing balance method or the return down value method. Okay, you have to show your machinery account for all of the 3 years from 2018 to 2020. Your year end would be 31st of December. So there is very much of purchasing and selling of these. So if you see the depreciation, statement of depreciation, they have bifurcated all the machine. The machine number one of 80,000, the machine number two of 40,000, machine number three of 20,000. Okay, so the first machine which was purchased of 80,000, out of this 80,000, how much is sold? The machine costing 32,000 is sold. So what they have done, the unsold machine and the sold machine, they have bifurcated this 80,000 into sold and unsold. In the same way, this second machine which was purchased, this will be also bifurcated into the sold amount and the unsold amount. Sir, why they are doing the bifurcation of sold and unsold? Because I need to calculate the profit or loss on sale of machine. I need to calculate the profit and loss on sale of machinery. So what they have done, they have mentioned the book value. They have calculated the depreciation, which is 10%. Okay, this is used for the whole year. That is why the depreciation is for the whole year. So WDV after 1 year, it is 43,200 and WDV for this, it is 28,800. Then if you move on, again, the second year depreciation is charged at the rate 10% on your WDV. So what was the WDV? It is 43,200. So depreciation is 4320. It is 28,800. So depreciation is 2880. Okay. Then moving on. In 2020, just remember now the machine is sold. So we have brought down the opening WDV over here. Opening WDV is mentioned over here. On 31st of March, the machine is sold. And the machine which was purchased on 1st of January, it is sold on 30th of June. So for 6 months, the depreciation will be charged on it. So if you see, the depreciation is charged up to 6 months on the machine which is sold. So this machine is sold. The WDV was 25,920. The rate of depreciation was 10%. And and it is charged for only and only 6 months. So 25,920 into 10% into 6 divided by 12. So the depreciation would come as 1296. So the cost of machinery was actually 25,920 minus 1296. It was the written down value and it is sold for how much? It is sold for 26,700. So what is the profit? The machine was of 24,000, but it is sold for 26,700. So the profit is of 2,076. So that is the statement which they have prepared for every sold and unsold part of the machinery. This you have to do only in case of when you have purchased more than one machine or part of asset is sold. So in this case, if you see, the machine one was of 80,000, but it has two part, 48,000 and 32,000. 32,000 was sold. So for calculating this, we have done all this calculation. Okay, same we have done for machine 2 and machine 3. We have calculated the depreciation and everything. Once you do all this, now machinery account is very easy. Okay, so whenever you purchase the machinery, it bank account to bank account 80,000, depreciation will be charged as per your calculation. So here the depreciation in the first year was charged 4,800 plus 3,200. The depreciation is charged as 8,000. So it is credited to your machine account 8,000. And the balance amount is 72,000. Your year is ended over here. So the balance is carried down as 72,000, which is now brought down in the next year as 72,000. Now I have purchased on 1st of July a new machinery of 40,000. Again, that is mentioned. Depreciation from your table is mentioned and the balance carried down is mentioned. The same way you can do the rest of part. The balance is brought down in the next year. Machine is sold for that amount. Depreciation is charged. If there is profit and loss on sale of machinery, that is booked, and profit and loss on sale of machinery, which is booked. Bank account, we have purchased a new machinery, and at last we will have the depreciation entries for the machine and the sale. So the closing balance would be 78,432, which is the WDV of all the machines. Just try this question by yourself first, and if there are any doubts, we can solve it together, or we can solve one more question just like that again in the upcoming class. Okay, now let us understand the last method for today, that is the NUT method. NUT method means every year, like we have done in the sinking fund method, annual depreciation should be charged based on a rate which is given. Okay, so there is a NUT table which is being prepared for this. I will show you one of the NUT table. Just look at the illustration number 6, you will understand. Shri Tirthankar takes a lease of 5 years for 10,000. He decided to write off lease by annuity method, charging 5% interest per annum. Show the lease account for 5 years. Obviously, this is not a part of depreciation, but if they have given, so we are discussing it. Now, in the question, they have given an information that the annuity table shows annual amount necessary to write off 1 rupees in 5 years at the rate of 5% is 0.230975. So how much amount he needs to write off? That is 10,000. So just multiply the 10,000 by the annuity amount of 0.230975. It would be 2309.75 rupees, which he need to take it out. Okay. So if you see the sinking fund investment account, the same process is done. Same process is done. 2309 is converted approximately to 2310 rupees per year. Okay. So in the same way, in the sinking fund investment, the opening balance is of 10,000. Depreciation is charged every year. There is an interest which is 10,000 into 5%, that is 500 rupees. Depreciation is of 2310. The closing balance is 8190. The closing balance is brought forward over here. We have charged the depreciation of again the same amount, and interest is calculated on 8190 multiplied by 5%, that is 410. And then we have a closing balance of 6290. Then again this is brought forward. There is again a depreciation. Interest is calculated on 6290 multiplied by 5%, 315, and the balance carried down is 4295. Then 4295 interest, depreciation total, and in the last year this will be automatically balanced. This is the NUT method. This is not done for the asset, this is done for a liability. Okay, this is done for a liability. What kind of liability? I need to pay 10,000 after 5 years. So that is why if I have taken this in the first year, I need to invest that money, 10,000 rupees. I need to invest it somewhere so that I can get that money back. Okay. That was the simple thing. Nothing very, not in terms of marks, it is important, but just for the understanding that what is the NUT. So if I tell you on a simple terms, if I am doing a EMI, of every year. Let's say for 3 years, I am doing a EMI, 1000 rupees, 1000 rupees, 1000 rupees. And there is a fixed rate of interest of, let's say 10%. So on the first investment, I will receive a interest of 10%. I will get 100 rupees. Now this 100 rupees will be invested again into that. So now my investment would be 1100 rupees. Along with 1100, I have added 1000 rupees extra. So now my investment is 2100. Now I will get 10% of 2100, that is 210 rupees. So now what is the total balance? It is 2100 plus 210 rupees, that is 2310. Total balance is 2310. Now I have added this 2310 and 1000 rupees. This will become 2310 plus 1000, that is 3310 multiplied by 10%. So the interest is 331 and the original investment of 3310. So it would become 3641. That is the rupees I will get after 3 years. What I have actually invested, I have invested just 3000 rupees. But what I have got in return, that is 3641. Why? Because my is also getting interest is also getting reinvested. My interest is also getting reinvested. If interest is not getting reinvested, this is a very simple case. Okay, this is just 1000 rupees. 10% of 100 rupees I got, I take off this 100. Now I have invested another 1000. So my total balance is 2000. 10% would be 200. I take off this 200. Now I invested another 1000. There is a 10% of interest. The interest is 300. I take off that interest. That is a very simple calculation. But this is called reinvestment method. This is done when there is an annuity. Okay, a same amount has been invested. So that concludes your topics for today. Next class, we are mostly going to do the revaluation method, then the depletion unit method. These are very easy method which we are going to come across. Then there is a important topic, that is provision for depreciation account. Okay, that we are going to cover. That is also important but easy. And then we are going to dispose of the asset, obviously the profit and loss on sale of asset. So that we need to cover in the coming part, and some consolidated question like here illustration number 9, etc. Profit and loss sale of method for calculation. Okay, and at last there would be change of method. For example, earlier I was using the SLM method. Now I want to shift to WDV method. So how I can change from today or from any earlier period. Earlier the management was saying to follow the SLM, but now they are saying that let's from today apply the WDV method. So how to change it? But now if management says let's go to the WDV method since the day one, now already 3 years has been passed and 3 years I am using the SLM, but now how I can go to the WDV method since the day one? So that is the process which we are going to talk about in the change of method. Okay, and that is all about the some of the theory which is coming ahead, and that would be all for this chapter. So I think there would be one or two more classes on this topic, and then we are going to finish it off very soon. Okay, till then, if you have any doubts, just collect it out and bring me on the chat box in your next class, and we will discuss it and move ahead. Okay, okay, guys, see you then all in the next class. Bye bye. Take care, all of you. Take good care of yourself. Bye all.